You know that feeling when you watch something massive unfold and you weren't part of it? That sinking sensation in your gut when gold hit new all-time highs and you were sitting on the sidelines. I get it. I've talked to hundreds of investors who feel exactly that way right now. They watched gold climb from $1,800 to over $2,700, and they're kicking themselves. But here's what almost nobody is telling you, and this is going to sound counterintuitive at first. Missing that gold rally might be the best thing that ever happened to your portfolio. Let me explain something that's happening right now in the precious metals market that most people completely miss. While everyone's focused on gold's spectacular run, there's a metal that's been quietly setting up for something that could make gold's performance look modest by comparison. And the setup we're seeing right now? It's almost identical to what we saw in gold back in 2019, right before it exploded 50% higher. I'm talking about silver. And before you roll your eyes and think this is just another silver to the moon pitch, I need you to understand something fundamental about how these markets actually work. Because what's happening right now isn't speculation. It's not hopium. It's basic supply and demand economics playing out in real time, and the numbers are absolutely staggering. Let me take you back to 2019 for a moment. Gold was trading around $1,400 an ounce. The gold bugs were excited, sure, but the mainstream financial media was largely ignoring it. Central banks were buying, but quietly. The smart money was accumulating positions while everyone else was chasing tech stocks. Then, 2020 hit. Pandemic. Money printing on a scale we'd never seen before. And gold did exactly what it was supposed to do. It rocketed to over $2,000 an ounce. A 50% gain in just over a year. Now here's what's fascinating. Silver followed that same pattern, but with one critical difference. When gold moved 50%, silver moved 100%. It literally doubled from $12 to nearly $30 an ounce. And this wasn't a fluke. This is what silver does. It's more volatile than gold. It has industrial demand that gold doesn't have. And when precious metals bull markets really get going, silver consistently outperforms gold by a factor of 2 to 3 times. So why am I telling you this now? Because we're seeing the exact same setup play out again. Except this time, the fundamentals are even more compelling. Gold just had its massive run. It's up over 40% from its 2022 lows. Central banks bought more gold in 2023 than any year on record. The smart money already made their move in gold. But silver? Silver is still trading at levels that, when you adjust for inflation, are cheaper than they were 40 years ago. Think about that for a second. In 1980, silver hit $50 an ounce. Adjusted for inflation, that's over $180 in today's dollars. Right now, silver is trading around $24. We're talking about a metal that's 85% below its inflation-adjusted all-time high, while gold is making new nominal highs almost every week. This is the kind of disconnect that doesn't last. It can't last. And when it corrects, the move is going to be violent. But here's where it gets really interesting. The reason silver lagged gold initially is the same reason it's about to catch up in spectacular fashion. Industrial demand. You see, gold is primarily a monetary metal. Central banks buy it. Investors buy it. It sits in vaults. But silver? Silver is getting consumed. It's being used up in applications where it can't be recovered. And the amount of silver being consumed right now is breaking records. Let me give you some numbers that should make your jaw drop. The solar industry alone is projected to consume over 200 million ounces of silver this year. That's nearly 20% of total global silver production. And solar installations are growing at 25% per year. Electric vehicles use 2 to 3 times more silver than traditional cars. Each EV contains about 25 to 50 grams of silver in various components. We're adding millions of EVs to global roads every year. 5G infrastructure, AI data centers, defense systems, medical devices. Every single one of these growing industries is a massive silver consumer. Here's the problem. Global silver mine production is essentially flat. We're producing about 830 million ounces per year from mines, and that number hasn't grown meaningfully in a decade. Meanwhile, total demand, when you add up industrial use, jewelry, silverware, and investment demand, is running at about 1.2 billion ounces per year. We have a structural deficit of nearly 400 million ounces annually. That deficit is being filled by above-ground stockpiles, But those stockpiles are getting depleted at an alarming rate. The Silver Institute just released data showing that identifiable silver inventories have dropped by over 300 million ounces in the last 3 years. COMEX warehouse stocks are at multi-year lows. The London vaults are seeing drawdowns. And here's the kicker. Unlike gold, where central banks hold massive reserves that can come to market, there's no central bank silver. There's no strategic silver reserve. When the above-ground stockpiles run out, there's no cavalry coming to save the market. Now, I know what some of you are thinking. You've heard this story before. Silver bugs have been predicting a supply crisis for years, and you're right to be skeptical. But here's what's different this time. The industrial demand isn't speculative anymore. It's real, it's happening, and it's accelerating. Let me tell you about what happened in the solar industry just last year. Silver prices spiked briefly to $32 an ounce in May 2024. Within weeks, solar manufacturers were scrambling. Production lines were being adjusted. Engineers were working overtime to reduce silver content in solar cells. Some smaller manufacturers actually had to pause production because they couldn't secure silver at prices that made their panels economical. This wasn't a hypothetical supply crisis. This was real-world disruption from a relatively modest price increase. Now imagine what happens when silver goes to $40, $50, or $60 an ounce. The industrial users can't just stop buying. They need the silver. Solar installations are being mandated by governments around the world. EV adoption is being pushed by regulatory requirements. 5G networks are being built out because our entire digital economy depends on them. This demand is inelastic. It's not optional. And that creates a very different dynamic than we've ever seen before in the silver market. But there's another factor at play here that's even more powerful. Investment demand. Right now, investment demand for silver is relatively muted. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is sitting around 88 to 1. Historically, that ratio averages around 60 to 1. In previous precious metals bull markets, we've seen it drop to 30 to 1, or even lower. If that ratio just reverts to its historical average while gold stays at current levels, silver would need to trade at $45 an ounce. If it drops to 50 to 1, which is entirely possible in a strong bull market, we're looking at $54 silver. And here's where it gets really explosive. When silver starts moving, it attracts attention. Retail investors pile in. We saw this in 2011 when silver went parabolic. We saw it again in 2020 during the Wall Street Bets silver squeeze attempt. Silver has a retail following that gold simply doesn't have. It's more affordable. People can buy physical silver without needing thousands of dollars. And when the momentum starts, it feeds on itself. The smart money knows this. That's why we're seeing some very interesting positioning in the silver market right now. Hedge funds have been building long positions in silver futures. The Commitment of Traders report shows managed money is net long, but not excessively so. There's still plenty of room for additional buying. Meanwhile, the commercial traders, the big banks and mining companies that typically hedge their positions, are holding near-record short positions. And you know what that means? When silver starts to run, those shorts are going to have to cover. That's fuel for a short squeeze on top of everything else. Let me paint you a picture of what this could look like. Imagine silver breaks through $30 an ounce convincingly. That's only 25% from current levels. Not a huge move in the grand scheme of things. But that $30 level is psychologically significant. It's where silver topped out in 2020 and 2021. Breaking through that level would signal to technical traders that a new leg up is beginning. Money would start flowing into silver ETFs. The big funds would start adding silver exposure to their portfolios. Retail investors would start buying physical coins and bars. As that buying pressure builds, the industrial users would start to panic. They'd begin forward buying, trying to lock in supply before prices go even higher. That additional demand would push prices higher still. The shorts would start to feel pain. Some would cover, adding more buying pressure. And suddenly, you'd have a self-reinforcing cycle. This is exactly what happened in 2010 and 2011, when silver went from $18 to $49 in less than a year. Now, I'm not saying silver is going to $49 next month. Markets don't move in straight lines. There will be pullbacks. There will be volatility. Silver is not for the faint of heart. But the setup we're seeing right now, with structural supply deficits, accelerating industrial demand, and a gold-to-silver ratio that's historically stretched. This is the kind of setup that comes around maybe once or twice in a decade. And here's the beautiful irony. All those investors who feel like they missed the gold rally, they're actually in the perfect position. Because the capital that's going to flow into silver isn't going to come from people who are already in gold. It's going to come from people who missed gold and are looking for the next opportunity. It's going to come from industrial users who need to secure supply. It's going to come from momentum traders who see a breakout happening. The fact that you're not already positioned in gold means you have dry powder to deploy into what could be an even better opportunity. Let me tell you about a conversation I had with a mining executive a few months ago. This is a guy who runs one of the largest primary silver mining operations in the world. And he told me something that really stuck with me. He said, "We're producing silver as fast as we possibly can, and we can't keep up with demand. Our forward sales are already booked for the next 6 months. And the scary part is, we don't have any way to significantly increase production. The ore grades are declining. The easy deposits have already been mined. Even if silver prices doubled tomorrow, it would take us 3 to 5 years to bring new production online." Think about what that means. The supply side of this equation is essentially fixed. There's no quick way to produce more silver. But the demand side is accelerating. Every solar panel installed, every EV manufactured, every 5G tower built. That's silver being permanently removed from the market. And unlike gold, which mostly just changes hands, silver is being consumed. It's gone. And we're consuming it faster than we're producing it. Now, quick aside here, because I know some of you are thinking about how to actually position for this. If you're sitting on $100,000 or more in retirement accounts, you might want to look into how precious metals IRAs work. I put together a free guide that covers how you can get physical silver or gold into your retirement account without triggering tax penalties. It's in the description below. Worth checking out if that's relevant to your situation, especially given what we're seeing in these markets. Anyway, back to where this is headed. Because there's another dimension to this story that we need to talk about. The monetary aspect. We've been focused on the industrial demand story, and that's huge, but let's not forget that silver is also money. It's been money for thousands of years, and in times of monetary uncertainty, people turn to precious metals. Look at what's happening in the global monetary system right now. The BRICS nations are actively working to reduce their dependence on the US dollar. Central banks around the world are diversifying their reserves. We're seeing the early stages of a potential shift in the global reserve currency system. And when that kind of uncertainty exists, precious metals become more attractive. Gold gets the headlines, but silver has always been the people's money. It's more accessible, it's more affordable, and in a real monetary crisis, silver could actually be more useful than gold for everyday transactions. There's a reason why silver is mentioned in more constitutions and legal tender laws than gold. There's a reason why the US dollar was originally defined as a specific weight of silver. Silver has monetary properties that are deeply embedded in human history and psychology. And when people start to lose faith in fiat currencies, they don't just buy gold, they buy silver too. We're already seeing signs of this. Physical silver demand has been incredibly strong over the last 2 years. The US Mint has had trouble keeping up with demand for silver eagles. Premiums on physical silver coins and bars have been elevated. Dealers are reporting inventory shortages. This is happening while the paper price of silver has been relatively subdued. That disconnect between physical demand and paper prices is another sign that something is building in this market. And here's something that should really get your attention. The big institutions are starting to notice. We're seeing more research reports from major banks talking about silver's industrial demand story. We're seeing mining companies shift their focus towards silver production. We're seeing new silver-focused ETFs being launched. The institutional interest is building, and when institutions start to allocate capital to a relatively small market like silver, prices can move very quickly. The total value of all the silver in the world, if you add up all the above-ground stocks, all the jewelry, all the industrial inventory, everything, it's maybe $1.5 trillion. That sounds like a lot until you compare it to gold, which is over $15 trillion. Or compare it to the global bond market, which is over $130 trillion. Silver is a tiny market, and when big money starts to flow into tiny markets, you get explosive price moves. Let me give you a historical parallel that I think is really instructive. In the late 1970s, we had a similar setup. Inflation was raging. The dollar was weak. Gold was in a bull market. and silver was lagging. Then, in 1979, silver started to catch up. It went from $6 an ounce in January 1979 to $50 an ounce by January 1980. That's more than an 8x move in 1 year. Now, I'm not predicting that kind of move this time. The circumstances are different. But the point is, when silver decides to move, it can move fast and far. What's interesting about our current situation is that we have both the monetary factors that drove silver in the 1970s and the industrial demand factors that didn't exist back then. In the 1970s, silver's primary uses were photography, jewelry, and silverware. Today, we have all of those plus solar, EVs, 5G, AI infrastructure, and a dozen other high-tech applications. The demand base is broader and more resilient than it's ever been. And here's something that keeps me up at night, in a good way. We haven't even talked about what happens if there's a real supply disruption. Most silver production comes from just a handful of countries. Mexico, Peru, China, Australia, and Chile account for about 60% of global mine production. What happens if there's a political crisis in one of those countries? What happens if there's a major mining accident? What happens if environmental regulations force mine closures? Any of those scenarios could take millions of ounces of supply off the market overnight. And in a market that's already in deficit, that could send prices absolutely vertical. The risk-reward here is asymmetric in a way that we rarely see. If I'm wrong, if silver just muddles along at current prices, you're looking at a metal that's still historically cheap, that has industrial demand growing at double-digit rates, and that serves as insurance against monetary instability. That's not a bad place to be. But if I'm right, if silver catches up to gold the way it has in every previous precious metals bull market, we could be looking at a double or triple from current levels. And if we get a real supply squeeze on top of that, the upside could be even more dramatic. I want to be clear about something. I'm not telling you to bet the farm on silver. I'm not telling you to go all in on silver mining stocks or silver futures. Those are volatile, risky instruments that can lose you a lot of money if you're not careful. What I am telling you is that if you're looking at the precious metals space and feeling like you missed the boat on gold, you need to take a serious look at silver. Because the opportunity in silver right now might actually be bigger than the opportunity in gold was 2 years ago. Think about your portfolio allocation. Think about what percentage of your wealth is in assets that are dependent on the continued stability of fiat currencies and the continued smooth functioning of the financial system. For most people, that's 100% of their portfolio. Stocks, bonds, real estate, even cash in the bank. All of it depends on the system working the way it's supposed to work. And maybe the system will work. Maybe we'll muddle through. But what if we don't? Silver, like gold, is an asset that exists outside the financial system. It's not someone else's liability. It can't be printed. It can't be debased. And unlike gold, it has this massive industrial demand component that provides a fundamental floor under the price. That combination of monetary properties and industrial utility is unique. There's no other asset quite like it. And here's the thing that really gets me excited. We're still early. The mainstream financial media isn't talking about silver yet. Your neighbors aren't talking about silver. The talking heads on CNBC aren't breathlessly reporting on silver prices every day. That's going to change. And when it does, when silver becomes the story that everyone is talking about, that's when the real move happens. That's when the momentum kicks in. That's when the fear of missing out drives prices to levels that seem crazy in hindsight, but feel inevitable in the moment. I've been watching precious metals markets for a long time. I've seen multiple cycles, and I can tell you that the setup we're seeing in silver right now is as compelling as any I've seen. The fundamentals are there. The technicals are setting up. The sentiment is still skeptical, which is exactly what you want to see at the beginning of a major move. All the pieces are in place. So if you're sitting there feeling like you missed gold, stop. You didn't miss anything. You're actually in the perfect position to catch what could be an even bigger opportunity. The gold rally validated the precious metals thesis. It proved that in an environment of monetary instability, currency debasement, and geopolitical tension, precious metals are where capital flows. Now that thesis is going to play out in silver. And because silver is smaller, more volatile, and has this industrial demand kicker, the move could be even more dramatic. This is your moment. This is the opportunity that you'll look back on in 2 or 3 years and either feel grateful that you acted or regretful that you didn't. The choice is yours. But don't let fear of missing out on gold's rally blind you to what's setting up in silver. Because if you think you missed gold, you haven't seen anything yet. The silver story is just beginning, and it's going to be bigger than most people can imagine.